If you're looking for a combination of weekly income and exposure to high-growth themes like AI, crypto, and precious metals, while avoiding the NAV erosion issues that hurt a lot of yield-focused ETFs, KYLD, or K-Yield, as Howard Chan, the CEO and founder of Curve Investment Management, calls it, could be worth a closer look. This actively managed ETF just launched, and it focuses on high volatility opportunities designed to generate premium income. Drawing from Howard's recent interview, we'll break down how it works, what makes it different from other ETFs, and whether it might have a place in your portfolio. K-Yield isn't your typical passive index fund. Howard Chan structures the portfolio around two core pillars: high-growth securities, equities, or other instruments with accelerating earnings and multiple expansion potential, and high-implied volatility names where options premiums are substantial and opportunities for income are abundant. These often overlap. Think of companies with strong revenue growth and volatile option markets, but the focus is on businesses you can understand, not pure speculation. The fund spreads its investments across 5 main themes to give investors multiple ways to make money. It's actively managed, meaning holdings change over time. They review the main themes every few months, and they also use options strategies weekly or monthly to boost income. The fund uses a mix of options strategies, covered calls to earn extra income while keeping upside potential, put spreads to protect against small dips, and directional bets using calls and puts for extra gains. In simple terms, this is a next-level options income approach. They start with more exposure than usual, then adjust with calls to track the market closely, so it can earn more than traditional covered call ETFs that cap your gains. You can expect bigger, more volatile payouts with K-Yield compared to some of Curve's other strategies. But Howard Chan warns investors to not get excited and chase the first payment. Early payouts are often used to build a cushion in the fund's NAV, which helps prevent losing money over time. Because if the NAV drops 50%, you would need a 100% gain just to get back to where you started. To avoid this, the fund banks premiums from options trading first, so payouts can be consistent without eating into your capital. The idea is old school. They want investors to make real returns on top of their money, not just pay income by slowly eating the original investment. So the goal is, as NAV stabilizes, distributions rise, which results in better total returns over time. K-Yield invests across all liquid options markets, not just tech like KQQ. That makes it more volatile and focused on growth, so it's best as a satellite position for investors willing to take on more risk for bigger potential payoffs. By comparison, KQQ is more of a core holding. Big, stable tech companies like NVIDIA provide consistency. K-Yield goes after smaller AI and tech companies. These can move faster and give higher returns, but they also carry more risk. Both funds use similar tools, but K-Yield takes it further. It leans heavily on options with high implied volatility, about 80 to 100%, to collect premiums. It also uses puts to protect against downside. Rebalancing happens regularly, thematic holdings are reviewed quarterly, and options are rolled weekly or monthly, often tied to earnings events. The fund stays diversified and avoids extremely risky, 3 times leveraged products, keeping the strategy risk-adjusted and sane. Howard is candid. He warns that tech stocks are at all-time highs, valuations are stretched, and many growth drivers are fading after earnings. That's a signal to be cautious. Tech's capital spending has been a big driver of GDP, and without it, a slowdown or even recession is possible. Fed cuts could help, but if inflation sticks around, many stocks are still overpriced. On top of that, troubles in private debt markets could spread quickly. Optimism can reverse in a heartbeat. K-Yield itself can be volatile. You might see 3% up days and 1% down dips. This fund isn't for people obsessed with NAV or looking for low-risk, steady income. You need to be ready for swings. K-Yield stands out because of its forward-looking approach, by investing in AI infrastructure and precious metals in ways that match long-term trends. Its options strategies are intended to make it more sophisticated than typical income ETFs. The focus is on risk-adjusted returns, not just chasing the highest yield. In a market that goes from bullish to choppy, this approach could help protect NAV, which is important for retirees who might use the distribution payouts to fund their lifestyle. That said, it's still a new fund, so the track record is short. Volatility could hit if key themes don't perform. For example, if crypto keeps moving with the broader market. Fees are modest, but exist. and the tactical bets mean there's manager risk. I'd personally consider KYield as a small satellite position, maybe 5 to 10% of a portfolio, for investors seeking aggressive growth plus income. I'll be honest, I'm not too familiar with Curve's ETF lineups, but after watching the fund manager's recent interview, I'm definitely paying closer attention. You can usually tell how conservative or aggressive a manager is by looking at their past performance and how they handle different market conditions. For now, I'll be watching from the sidelines to see how this fund performs, but I'll admit I'm a little impressed by the structure, the ideas, and the potential here. It all comes down to execution from the management team. If you found any value in this breakdown, make sure to like the video and consider subscribing so you don't miss future updates.